Pankaj Murarka joining us this morning. He's CIO, Renaissance Investment Managers. Pankaj, always a pleasure to speak with you and a very good morning to you. I mean, do you see markets breaking out soon out of this consolidation phase? And in terms of valuations, that's a conversation we were having earlier on the show. Do you think valuations for the Indian markets are not as much of a pain point as they were, say, a few months ago?
Morning, Tamanna. Always a pleasure talking to you. I think, let me start from a valuation point and then I'll come to markets. I think we need to concede it's a given that India is the most expensive equity market in the world, and it's nothing new. We've been the most expensive equity market in the world in the last 20 years. Even when China economic miracle was unfolding and China was the fastest growing economy in the world, India was not. Even then, Indian equity markets were the most expensive equity market in the world. Today, clearly, we have a situation where obviously India is the fastest growing economy in the world. And I think it will remain the most expensive equity market in the world because India is the only secular growth story out there in the world. You try to look at the world from the top of Eiffel Tower view. Then when global investors, largely US-based investors, they look at outside of their home market, the only country where they can take a secular bet for the next 20 years, which they know will grow year after year for the next 20 years, it's India. So obviously we'll have the amount of money that is chasing India will be far higher than what this market can absorb, and valuations will always remain expensive. If you ask me today, I think the valuations are pretty much in line with last, mean average of 15 years. So to that extent, they are okay. But yes, in absolute terms, India has and will remain expensive. In terms of current context of markets, I think it'll be good if markets can consolidate here around this, spend some more time, because we've had a very sharp rebound in the last 8 weeks from the lows that we've had. But I still hold that view. One, we fundamentally remain structurally in a bull market, which effectively means that annualized returns will be positive on the index. And I still think this year could be a year where index, meaning if you look at Nifty index, we started the year at about 23,600 or so on 1st January. I think we could be in for about 15% gains for the year in the index, which effectively means we will make new lifetime high, I firmly believe, before the end of this calendar year on the index. So I think fundamentally we remain very much in a bull market, which effectively means any fall is a correction in the bull market and is an opportunity to buy into that bull market.
Got it. Pankaj, hi, morning, Neeraj here. But just wondering, Pankaj, I mean, we were just doing the math after this corrective move the last few days, we are probably circa 20 times with an assumption of anywhere between 8 to 12% earnings growth for FY26. At 20 times for a market which is growing, which has the predictability of growth that you spoke about, oil prices lower, RBI cutting rates, inflation stable for so many years now, why should it be considered expensive as well? I mean, it may be the most expensive on numerical terms, but 20 times may not be really very expensive valuations, right?
Yeah, I think that's a new normal or base for India, Neeraj, in that sense, given historical trends. Logically, we are in the midst of a growth slowdown. Last year, we had one of the slowest earnings growth in Nifty index or Nifty 50 earnings in that sense at about 5%. As we, see a cyclical uptick in the economy from the slowdown that we've had in the last 5 quarters, still earnings growth, recovery will be modest. You're absolutely right. I absolutely agree with you. Given that the significant macro shocks that the world has had, let's say in the last few months, given the tariff plan unveiled by US, probably again it came out that India is the only economy which is the most resilient one and is the least impacted by those global macroeconomic shocks. So obviously India enjoys a valuation premium versus other peer markets. If you look at some of the other regional markets, they're trading at valuations and they've historically traded valuations which are significantly discount or lower than India. But I think probably 20 times 1 year forward earning is a normalized valuation for India in relative terms if you look at India's own historical averages. But I still think in relation to the world, it's expensive.
Pankaj, very good morning to you. I want to ask you about what you've seen in the earnings season and whether that's given you a reason to be a little bit optimistic heading into and looking at FY26 as well. You've spoken about a 15% increase at the index level. I'm just wondering what your base case assumption is for earnings growth as well, and what the drivers of that are going to be. Because we've seen a few companies come through, quite a few companies come through, surprising on the bottom line, and that is because of margin expansion that has taken place, and largely because input costs have been benign, and perhaps that is likely to stay the case in the first half as well?
So yeah, overall I remain sanguine and optimist on the market, as I said directionally, because we fundamentally remain in bull market, and I think, as I said, every dip is an opportunity to buy into this market, given the long-term structural story. Uh, Talking about the earnings season that we've just, at the fag end of this earnings season, I think the good thing about this earnings season has been, unlike the last two earnings season in September and December quarter, there's been no more incremental downgrades in the earnings. So on aggregate balance, if you see last quarter, earnings growth for, if you take the top 200 companies, has been about 7% in aggregate. Obviously, there are pockets where companies are surprised positively or earnings growth has been high, and there are pockets where earnings growth has been lower than expectation. But in aggregate, I think it's been pretty okay. More importantly, I think markets are always forward looking. So while now the low earnings growth is in the base, probably I think we are set for probably a low double digit, probably about 12% kind of earnings growth at the Nifty 50 or the Nifty 200 companies level going into this year in FY26, which is pretty reasonable, I think, given the fact that we are in a matured stage of this economic cycle. We are in the sixth year of this economic expansion, if I count it from the COVID-driven contraction that we had in 2020. So yes, a lot of earnings lever that exist at the early stages of an economic cycle in terms of capacity utilization or margin expansions to a great extent have been utilized. Obviously, companies have been making incremental investments in enhancing their capacities, and all of that will flow through. But I still think that about a 12% kind of earnings growth, probably over the next 2 years, is still not bad. And with that kind of earnings growth, I still think that the Nifty 50 index can comfortably do a 12 to 14% kind of returns for investors over the next 2 years, which I still think is very good outcome.
Pankaj, if you have specific comments on Sun Pharma, I'm sure my viewers will appreciate it. If not, what would you say about the triggers in this space? Some people are looking at it positively at this point, and CDMO certainly, based on the earnings that we've looked at, has looked quite good.
Well, yeah, that's true. So overall, I think, talking specifically about Sun Pharma, meaning one caveat before I say that is we are the owners of the stock. I still think the long-term story remains pretty much in place. I think, as Tamanna was highlighting, the guidance that the company has given is somewhat underwhelming. But we also need to keep in mind that Sun Pharma has a track record as a company of under-promising and over-delivering. So as a management, when they guide, they tend to be conservative in terms of the guidance. It's still the largest, it has got a phenomenal business being the largest pharma company domestically and the largest US business and so on and so forth. So I think the medium-term outlook for Sun Pharma, from my point of view, remains very positive. We'll be buyers on the dip. In that sense. Overall, I think the pharma space looks pretty decent. As you rightly said, CDMO is probably somewhere we're getting to an inflection point in that whole space where, given the cost pressures that the US companies are facing, we'll see accelerated outsourcing to India of both manufacturing, development, and research work. And that would mean that over the next, I think it's a decadal story where the whole space will see accelerated growth over the next 10 years. And we've seen stocks in the space have really done well. So any dip is a buy opportunity in CDMO space. Take a medium-term, long-term view. And it's a great opportunity to buy into these companies and stay invested for probably a long term.
Okay. Pankaj, I don't know if too many people who looked at IT as closely and for as long as you have. Now, a lot of notes have come out in the last 1 week which say that the commentary from the end clients as well as the IT companies is now increasingly looking okay, not looking as bad, so on and so forth. There was a note from Macquarie which said that maybe it's a decade of IT service companies versus product companies over the last decade because they will help clients navigate through the AI jungle. I would love to know, how do you think about the Indian IT space, large cap IT services, mid-sized companies, product companies, ER&D? Are you constructive, and if so, what's the first amongst equals?
Oh, Neeraj, I think you just summarized very well. I've been saying this for a long while that AI is the internet moment for entire technology world and for IT services company in India. There have been a lot of concerns that AI will cannibalize and negatively impact IT services company in India. But I don't think so that's going to be the case. I think there will be, a resetting of skill sets within the IT companies, and IT companies are pretty agile. They've navigated multiple technology shifts and trends over the last 20 years as the world moved, from ERP or cloud to ERP to cloud to digital and so on and so forth. And I think this is going to be the internet moment of the world, which effectively I mean the tech spends that we over the next 10 years, the surge that we'll see will be very significant. And as you rightly said, IT services company have a very important role to play because now that AI is here, or Chat GPT or whatever other fundamental foundation models are in place, those need to be implemented, and that can only be done and integrated into businesses, and that will mean huge amount of workflow for IT services company. So I think while the near term got clouded because of the tariff driven impact or fear of US economy slipping into recession, but incrementally clients in US are realizing, given that we have now withdrawal of tariffs or reversals, the US economy is being able to weather that. So the short term impact is not so negative. And I think medium term, we have started seeing AI driven deals, flowing in. So I clearly think that the next 5 or 7 years can be very significant, maybe in terms of growth trajectory for IT companies. And given that the stocks are already down about 15 to 20% from where they were, 3 months back, I certainly think that this is one pocket of the market where I clearly see that there's a gap between the overhang of fear and what the valuations are. So valuations present an attractive opportunity. You look a lot of large cap IT companies. Now they already had 4.5, 5% earnings yield kind of a thing, and that's where typically we've seen the sector or companies tend to bottom out. So I clearly think this is a good time to buy into some of these companies, take a slightly more medium term, longer term view, and the growth trajectory for the sector will certainly accelerate. And obviously, it will give rise to new champions as well. Every cycle in technology has given birth to new companies. Last cycle we saw in the last 5 or 6 years, you see Persistent and Coforge emerge, where they delivered very outlier growth over the last 6, 7 years. And from companies which were small in size at about 400, $500 million of revenues in 6, 7 years, these companies have delivered breakout growth, and all of them are now in $1.5 billion club, aiming for a $2 billion revenue. So I'm very sure that while large caps company will do well, there will be new companies that will emerge riding on the AI wave, and which will deliver breakout growth and probably get into $1 billion, $2 billion kind of a revenue club.
Sorry, do you like any of these businesses? I mean, they may eventually emerge winners. They may be a part of your portfolio. If you are at liberty, do you like any of these businesses or the guys who are pursuing these opportunities?
Well, we're engaging with a lot of these small cap IT companies, management, in terms of understanding their strategy and how they're preparing themselves to capitalize on, the oncoming AI wave and all of that. Obviously, you will appreciate that when you invest, you want to invest in a portfolio of 4 or 5 companies, because it's all about ability of the management to execute, and eventually few of them will emerge as winners. So clearly, we are trying to build a portfolio of a handful of small cap IT companies, I would say, which in the revenue, the sweet spot for buying IT companies, if you want to make exponential returns, is buying these companies when they're about $400, $500 of revenue. And then if they can deliver breakout growth and get to that $1.5 billion kind of a revenue. So that's the point, where you make uh, significant outlier returns in IT companies. That have happened in the last 5 or 6 years, if you see, with Persistent and Coforge. So the point is, which are those companies at this point of time, which are in that $300 to $500 million of revenue bucket, and which over the next 5, 7 years riding the AI wave can change their orbit. So obviously it's a portfolio approach that we're taking with about 4 or 5 companies that we're playing in. In large caps, I still think that some of the larger companies that we own are Tech Mahindra and Infosys that we own. And incrementally, we're getting constructive on Wipro as well, and we have ownership there as well, because we think probably after a long time, Wipro has got an insider as a CEO, and he's setting in a lot of things right in terms of the long-term business trajectory. Obviously, given the size and scale, these kind of transformational changes does take time. We need to give it 6 to 8 quarters. The new CEO is already in the role in 3 quarters now, but we think that's one company where probably it can catch up with industry. It has been an industry laggard for now 5 years. If it can catch up with industry growth within the large caps, probably Wipro can deliver the highest possible return amongst the 5 large cap IT companies in India.
Just what you said, I found it very interesting, Pankaj, and I'm wondering if you're extending that to other ideas as well. Watch out for those that could be the winners of tomorrow and who are in that sweet spot. What are, the other spaces where you see that potential?
Well, as growth investors, Tamanna, we're always looking for outlier growth or breakout growth.
Are you
So
seeing
which
are you
are
seeing
companies,
enough candidates right now, and in which space?
trust me, more than enough. India is such an exciting place. There's so much of energy, there's so much of entrepreneurship, there's so much of risk-taking ability. I've always had in my 28 years of career more ideas than the money I've had to invest. So, talking about spaces, internet continues to excite me. There's so many of these things happening. I still think well-run internet companies can keep growing, whether they're fintech, whether they're consumer tech, or across other different segments, they can still keep growing at 25-30% for the next 10 years because there's so much growth out there. Of late, I've started liking consumer as a space. Just to give you a context, India's total consumption is about $2.6 trillion. If it was economy, it would have been the eighth largest economy in the world, and that is growing at 10-11%. Much higher, probably much higher than a lot of other economies are growing. Within that consumer space, companies which are doing innovative things, which are making strategic bets in their businesses, can deliver much higher growth and create significant amount of shareholder wealth over the next 10 years. So we are clearly looking for companies either by their business or through management actions, which are probably can deliver breakout growth over the next 5 or 10 years, and whereby the companies can change their orbit, which is where you make the outlier returns. Because as I said, let's understand, the markets are priced to perfection. Then how do you make outlier returns is by finding companies, going deep down, finding companies which are executing strategic business plan to deliver outlier growth. And I think there are significant opportunities there. Every day I look at few companies and I feel very excited about these companies. One has to be careful in terms of stock selection, but there is no dearth of opportunities, I must concede.
Pankaj Murarka, lovely talking to you today. Thank you so much for taking the time out and being with us.